Optimal allocation, multiple assets. In this video, we will look into allocation between a portfolio of stocks and the risk-free investment, in this case a bank deposit. We will draw capital allocation line, a line that shows the return from different combinations of stock portfolio and the bank deposit. We will first find the combination of stocks that maximizes the Sharpe ratio. Sharpe ratio is the risk-adjusted excess return. The expected return of the portfolio is calculated by this formula, where the Y is the weight of the risky portfolio and 1 minus Y is the weight of bank deposit. How much a person should invest in Y depends on that person's risk aversion and their risk aversion coefficient. The higher the value, the proportion invested in the risky portfolio decreases. I won't go too much into this topic, but usually risk aversion coefficient isn't higher than 5, but some economists have argued that it can go higher than 5. When we know the risk aversion coefficient and the investor's expected return, we can calculate how much the investor should allocate the capital to the risky portfolio. We add more rows in our spreadsheet. Sharpe ratio, risk aversion coefficient, Y, that is the weight in the stock portfolio, and 1 minus Y, that is the weight in the bank deposit. Also a column for the risk-free return. A 1-year certificate of deposit is at the moment around 2.6%. We will use it to represent the risk-free rate. Let's first find the combination of stocks that maximizes the Sharpe ratio. Sharpe ratio is the risk-adjusted return. Basically, the return that exceeds the risk-free rate when you take on one more unit of risk. So you take the return of the portfolio minus the risk-free rate divided by standard deviation of the portfolio. This gives 1.71 Sharpe ratio for the portfolio that we constructed earlier. We will be using solver function of the spreadsheet. With solver, we can find the maximum value of this cell by changing the value of these cells. So data solver, set this cell to maximum by changing these cells. We add a constraint and set these cells to be equal to 100%. That means 1. Okay, solve. Okay, this gives 22% in Apple, 24% in Amazon, 41% in Google, 6% in Microsoft and Berkshire, and this gives the Sharpe ratio of 1.90, the return of 26% and standard deviation of 12%. We can also set a constraint so that you don't invest more than 25% of your total capital into one company. So solver, add these cells less or equal to 25%. Okay, solve. Okay, this gives 25% in Amazon and in Google, 21% in Apple, 16% in Microsoft, 14% in Berkshire, and this gives Sharpe ratio of 1.89, return of 25% and standard deviation of 12%. Now we can draw the capital allocation line, a line that shows the return from different combinations of stock portfolio and the bank deposit. So insert, we will use a scatter chart. This one, right click, select data, and stock or portfolio return. The X value can be the standard deviation of the portfolio. The Y value can be the return of the portfolio. Okay, there. We will also include the return and standard deviation of the bank deposit. So right click, select data, add risk free. The X value, since it's risk free, the standard deviation can be 0, and the Y value will be the risk free rate 2.6%. Okay, there. We will make a line between these 2 points. So insert shapes, this one. There. This is the capital allocation line. It shows the extra return from the risk-free rate the more risk you take. Let's add labels on our chart. We remove the line temporarily and design, add element, legend, bottom, there, and we add back the line, and also add data labels there. The proportion of the total capital that should be invested in this portfolio depends on the investor's risk aversion coefficient. We will use this formula and a risk aversion coefficient of 2. So the expected return of the portfolio minus the risk-free rate divided by 2 multiplied by the risk aversion coefficient multiplied by the variance of the portfolio, and set the brackets. Also, we set a constraint so that the proportion doesn't go over 100%. There. With the risk and return of 12% standard deviation and 25% expected return, this gives us 100% of the capital that can be that should be allocated to the risky portfolio, and 0 to bank deposit. To better illustrate the concept of risk aversion, let's, instead of using the expected return of our stock portfolio, instead we will use the expected return of the S&P 500. Here we have the expected return of the S&P 500 and the standard deviation. So with the risk aversion coefficient still as 2, this gives, so you take the expected return, in this case the S&P 500, minus the risk-free rate 2.6% divided by 2 multiplied by the risk aversion coefficient and multiplied by the variance of the S&P 500, set the brackets. So this gives 69% in the S&P 500 and 31% in the bank deposit. We will use this formula to calculate the return and the standard deviation of the optimal portfolio. So for the return, you take the weight in the S&P 500 multiplied by the expected return plus the weight in the bank deposit multiplied by the risk-free rate. This gives the expected return of 7.4%. And standard deviation, you just take the weight of the S&P 500 multiplied by the standard deviation of the S&P 500. This gives standard deviation of 11%. So for an investor with a risk aversion of 2 and who believes that the returns from the S&P 500 is representative for future return, this allocation is the most optimal trade-off between the risk and return. You can change the variables around to see how it affects the optimal allocation. For example, if we increase the risk aversion coefficient to 3, this increases the bank deposit proportion, and the portfolio return moves toward the risk-free rate. Also, if the risk aversion coefficient stays unchanged, but the risk-free rate rises, for example, to 4%, this also increases the bank deposit proportion. We can also see these changes in real life when the risk-free rate, like the 10 years treasury bills, rise to a certain level, the stock market falls right after. One of the reasons might be due to the investors' need to reallocate the capital to achieve a new optimal portfolio. On this video, we have learned how to construct a stock portfolio that maximizes Sharpe ratio, how to draw a capital allocation line, and construct an optimal portfolio consisting of stocks and bank deposit. In the next video, we will learn how to include other kind of assets into the optimal portfolio, in this case, a bond fund.